The NVIDIA stock NVDA is currently trading at $187.80, showing a powerful gain of plus $6.44 or plus 3.55% in today's session as of 10:30 a.m. EST. This movement is a decisive reversal, a strong upward push on heavy volume that is directly defying the bearish sentiment that has been building up over the last week. The general expectation going into today, ahead of the company's Q3 earnings call later this afternoon, was one of extreme nervousness. The stock had already pulled back substantially from its recent highs on valuation concerns and broad tech sector rotation, leaving many investors bracing for a volatile, potentially downside-biased outcome. The market narrative has been all about an AI bubble topping out, with everyone expecting a classic sell the news event, or at least a highly cautious sideways trading day leading up to the report. However, the reality of this morning's price action tells a different story. The stock is surging. This isn't just a technical bounce, it's a pre-earnings vote of confidence, driven by a sharp influx of buying power that is aggressively calling the valuation skeptics' bluff. The sheer scale of the move today, pushing the stock from an open near $184.79 to challenge $188, signals that a significant portion of the institutional community, which handles a large part of the investment volume in an individual brokerage account, is positioning for a beat and raise scenario, specifically on the data center guidance. They are not waiting for the afternoon's data. They are front-running a perceived positive surprise, which creates a powerful curiosity loop that is forcing short sellers to cover and fence-sitters to chase the move. The true tension in NVIDIA stock right now is between the fear of a massive correction, which the broader market has been whispering about, and the undeniable fact of sustained, almost unimaginable demand for their core product. When you look at the last week, the stock has been weak, dipping below $180 at one point, with volume remaining elevated on the sell side. This was a classic capitulation phase where retail traders and some hedge funds, fearing a disappointment, decided to take profits or cut losses. But today, the volume is surging again, and it's definitively green. This shift in intraday momentum is critical. A huge volume spike like the one we are seeing, leading into a major catalyst like earnings, often suggests that passive funds and large institutional investors, the kind that use platforms like Fidelity for their core holdings or manage massive index portfolios, are reweighting their positions to ensure they are not underexposed to a potential breakout. They look at the recent news, like the reports of a massive $100 billion AI infrastructure program involving NVIDIA stock, and realize the long-term CapEx trend is still pointing straight up. They see the data center segment is the engine, and the market's consensus on data center revenue approaching the upper $40 billion range this quarter might actually be conservative given the pace of hyperscaler spending we've observed. Let's zero in on the recent trading behavior because it holds the key to the pre-earnings drama. In the last 4 trading sessions, NVDA saw 3 down days and 1 flat close, with the stock losing about 4% of its value up until yesterday's close at $181.36. The selling was orderly but persistent, suggesting a systematic de-risking by some funds. However, the low volume on those down days relative to the previous month's average was a quiet counter-signal. It suggested that the big, core holders, the mutual funds and ETFs on platforms like Fidelity or those tracking major indexes, were largely sitting tight, not panicking. The real pressure was from short-term traders and some macro hedge funds adjusting their bets. Today's action, with an hourly volume that already dwarfs the average hourly volume of the past week, breaks that pattern. The stock gapped higher on the open and has trended strongly upwards, bouncing aggressively off its daily moving averages, indicating robust technical support has kicked in. This level near $184 is proving to be a critical line in the sand. For anyone using tools like the Schwab Intelligent Portfolios or any intelligent portfolio that auto-rebalances, this kind of volatile swing near a critical support level tests the conviction of the underlying algorithms. Beyond the daily swings, the institutional ownership activity, as reflected in recent 13F filings, although slightly lagged, confirms a complex picture. We see a high number of institutional owners, over 7,500, holding the vast majority of shares outstanding, which is typical for a stock of this size. What's interesting, though, is the nuanced activity reported around mid-November. While some firms show a slight decrease in shares, which could be routine trimming after a significant run-up, others like Aleska Investment Group reported a massive percentage increase in their stake, indicating a very strong conviction investment being made. We also note that insider activity over the last 3 months shows heavy net selling, which is a common phenomenon for top executives exercising stock options, but it is still a factor that adds to market jitters before a major event. These mixed signals perfectly embody the tension. Passive, long-only institutional money is largely committed, but active money is aggressively taking sides, either trimming on valuation concerns or piling in on growth optimism. The net result is the extreme volatility we see today, amplified by the options market, which is pricing in a massive expected move, north of 7% on the earnings news. This is why many individual investors using platforms like Robinhood for quick trades or SoFi Invest for their regular invest online positions are watching this like a hawk. To fully grasp why NVIDIA stock is acting this way, we must remember what the company actually does. NVIDIA is not just a chip maker, it is the infrastructure foundation of the global artificial intelligence industry. Its business model has dramatically shifted from being primarily a gaming graphics processing unit (GPU) company to a data center powerhouse. The data center segment, which is what analysts are watching most closely today, has become the company's primary revenue driver, fueled by the insatiable demand from cloud providers like Microsoft, Amazon, and Alphabet, often referred to as hyperscalers, for their high-performance computing chips. These chips are essential for training large language models, LLMs, and running complex AI workloads. The gross margin in this segment is exceptionally high, hovering around 72%, which is why the company's valuation, while high by traditional metrics like its P/E ratio, which sits above 50, is consistently justified by its unprecedented growth rate and margin profile. The older reports and past performance show a clear, almost parabolic acceleration in data center revenue over the last 2 years, overshadowing the performance of the traditional gaming segment. This transition is not a slow evolution, it is a rapid structural change in their business model, moving them from a cyclical hardware vendor to an almost essential infrastructure utility provider. The sector momentum is also entirely wrapped up in NVIDIA stock. The chipmaker is the single largest influence on the semiconductor index and one of the largest weights in the tech-heavy NASDAQ. When NVIDIA stock moves, it sets the tone for the entire sector, impacting peers like AMD, Qualcomm, and even major clients like Microsoft and Alphabet. The recent consolidation and slight sell-off in the broader tech space, which saw a few of the Magnificent Seven stocks enter correction territory, was largely driven by the pre-earnings anxiety around NVIDIA. This makes today's positive intraday move all the more surprising. It suggests that, despite the broader caution, there is still enough conviction in the AI theme to aggressively bid up the NVIDIA stock ahead of the official numbers. This is where investors in broad tech ETFs, or those using the Fidelity ETFs or SoFi ETFs for general tech exposure, need to pay close attention, because the underlying concentration risk is very real. A major move, up or down post-earnings, will disproportionately affect their portfolio returns. Looking ahead, the future outlook for NVIDIA stock depends entirely on 2 key pieces of information we will get this afternoon: the data center revenue figure and, more importantly, the forward guidance for the next quarter. The market's current expectation for next quarter revenue is aggressive, but the reality might still exceed it. Scenarios break down into a few distinct possibilities. The bull case, which the day's buying is pricing in, is not just a beat on revenue and EPS, but a substantial raise in forward guidance, likely driven by the continued strong ramp-up of the next-generation Blackwell chips and sticky long-term orders from hyperscalers. This would send the stock immediately past $200 and potentially challenge its all-time highs, validating the aggressive valuation and putting the AI bubble talk to rest for the immediate future. The downside risk, the bear case, would be a weak forward guidance that hints at a slowdown in capital expenditure from the cloud giants, perhaps a more disciplined approach to spending as Meta platforms recently signaled. Even if the current quarter is strong, any indication of future moderation would trigger a sharp sell-off, likely taking the NVIDIA stock back down toward the critical support level near $170, as the market values future growth above all else. This would in turn weigh heavily on the entire tech sector and confirm the fears that have been circulating. Another critical catalyst to watch, though not less immediate than earnings, is the competitive landscape.